Hey, it's Nolan Mathias from Mortgage 360, and this is the mortgage update for Monday, July the 20th. Today, we're going to talk about interest rates. We're going to talk about Tiff Macklem and his forward guidance from the Bank of Canada this week. And of course, we're going to talk about interest rates. But before we get into it, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button to make sure this video gets shared with as many people as possible. So let's get into it. Let's get into Tiff Macklem first and foremost. Bank of Canada governor, in his first interest rate announcement this week, during the question and answer period, said this about interest rates. He said, Canadians can expect interest rates to remain low for a very long period of time. Check out the clip here.
Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. Interest rates are very low, and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
So clearly giving some guidance to Canadians that they can expect low interest rates for a long time. Now, there's been some controversy back and forth about whether this is Tiff Macklem saying Canadians should go out and borrow money. I don't think that's the case. I don't think that's what he's suggesting Canadians should do, especially given the fact that CMHC has already tightened their guidelines. And I don't think it can be said any clearer in Canada that debt is not a good thing for consumers. So please don't go out, borrow a bunch of money. But what he is saying is that if you're worried about your mortgage payments, if you're worried about your credit card interest amount, if you're worried about, the current debt obligations that you have, you don't need to worry about interest rates increasing on those rapidly anytime soon. That's the message that he's sending, is don't fear rising interest rates and don't fear inflation, because in his mind, that is not something that we're going to have to worry about for at least the next 2 to 3 years. And we made a video all about how to take advantages from a mortgage perspective and how to expand your runway of low interest rates. I'll link up to it right here. And you can go and take a look and see how you can take advantage of what Macklem has said and what the Bank of Canada has advised, and how you can basically make it so that your interest rate stays lower longer using a variable rate mortgage. So check that out. And, let's get into interest rates on that note. How to use variable versus fixed and whatnot is what we talked about in that video. So let's talk about fixed versus variable rates. So as of this morning, Monday, July 20th, you can get a 5-year fixed with all the features, all the bells and whistles, low payout penalties for about 2.14%. If you want a fully discounted mortgage with things like bona fide sale clauses and restocking fees and all of that jazz, interest rates on those are running at about 1.89%. So a pretty substantial difference, about 25 basis points or 0.25%. But again, on most mortgages, that's a cup of coffee a week. And you really have to understand the difference between discount and non-discounted mortgages and the features and how those effectively cost you money over time. To give an example, we have 2 clients right now that we're moving from their existing lenders to lower rate mortgages. One of those clients had a mortgage with a discount lender. The other had a client with a not so discount lender, a great priced mortgage, full featured mortgage. The difference in the fees that they were being charged was $780. The discount lender would charge a $400 restocking fee and a $380 transfer fee. And those were fees that they just tacked on at the end in order for the client to be able to move to a different lender for a lower price. The normal product, the product that we like, the First National Mortgage, 2.14%, full feature. In order to move that mortgage, there was 0 fees tacked on. All they had to do was pay the penalty. So there can be a big difference between 2 different mortgages that seem like they're priced differently and one's priced cheaper, but at the end of the day, a discount mortgage at a lower interest rate can actually end up costing you more money over time when they tack on fees and all of those things. Let's talk about variable rates. Variable rates are, an interesting topic right now. We had a question on one of our YouTube videos about whether somebody should take a 1.99% HSBC fixed mortgage or whether they should take a 1.99% 5-year variable at a different lender. And what we said to that person on YouTube is that we would always, especially given what Macklem has said about interest rates going forward, we would always take a 5-year variable at 1.99% over an HSBC 1.99% 5-year fixed, because of the way that HSBC will calculate the penalty on that. And that's true for any big bank mortgage. As of right now, if I can get a variable and a fixed for exactly the same interest rate, I will take the variable all day, every day, in order to avoid penalties, because having low penalties will make us have more flexibility and the ability to make changes over time and ultimately save money. So as of right now, as of last week, the strategy's changed. We think that most borrowers should be variable rate borrowers. As far as interest rates on those go, we can get a fully discounted one with a bona fide sale clause, which I would not recommend because of the restocking fees, because of the transfer fees, because of the fact that you can't refinance to a lower rate. And that's especially important when we think that variable rates could go to prime -1 or prime -1.2 at some point in the next 3 to 4 years. But you can get a fully discounted variable rate at 1.75%. You can get a normal fully featured variable rate at about 1.99%. So that 1.99% fully featured 5-year variable is the mortgage that we're recommending, at least this week, at least going forward for the foreseeable future. And it's the one that we definitely are recommending right now. So that's what we've been seeing going on in the market. That's where we're at on interest rates and strategy. We also, have noticed that July has been a huge month from a funding perspective. So, and we expect that to follow through into August. All those deals that normally happen in May, June kind of got pushed back into July, August. So we're seeing a lot of activity in the market. And what better time to buy than right now, when we're seeing interest rates at the lowest that they've ever been. If you need to be in a house and need a place to live, now's the time to get into the market, because those interest rates being low is what's going to ultimately save you a significant amount of money over time, not necessarily saving $5,000, $10,000, $15,000 on the price of a house by waiting for the next 2 or 3 years. So, get in the market, take a look, and if you have questions, feel free to drop them in the comments below, and we'll see you on the next weekly update on the 27th. Cheers.